If you live in America, it seems like your job is less secure and at the same time your money buys a little less each day. For millions, this feels like a page torn out of a 1970s history book, but this isn't just a feeling. Hi everyone, I'm George Economy PhD economist, and in the next few minutes I'm going to look at the clear numbers on inflation and unemployment that show the threat of stagflation is very real. More importantly, I will break down what this means for you and your finances and how you can prepare for it. But before that, take a moment and subscribe to my channel. Almost 90% of you, my dear viewers, have not subscribed to my channel, and it will only help ideas and analyses like this one spread out to the world and meet the screens of more curious minds like you. So let's talk about a word you are hearing a lot lately: stagflation. It's a simple but difficult combination of a stagnant economy, meaning weak economic growth, job growth, and high inflation. It's the worst of both worlds. A shaky job market puts your paycheck at risk, while rising prices devalue the money you already have. For a long time, economists considered this a relic of the past, but the data from mid-2025 is starting to paint a concerning picture. First, look at the stagnation side. The American job market has slowed down considerably. In July 2025, the economy added only 73,000 jobs. To make things worse, the numbers for 2 previous months were revised down by a combined 258,000, which means hiring was much weaker this spring than first thought. The unemployment rate has edged up to 4.2% and has been stuck in that narrow range for over a year. In 32 major metropolitan areas, unemployment is now higher than it was a year ago. The bottom line is that job growth has cooled and the sense of security from a strong labor market is fading away. Now for the second part, inflation. While we aren't seeing the double-digit price hikes of the 70s, inflation is proving to be stubborn. The headline inflation rate in July 2025 was 2.7%. That might not sound extreme, but the trend is what's worrying economists. The rate has been accelerating and remains above the Federal Reserve's 2% target. Even more telling is the core inflation, which strips out volatile food and energy prices. That figure actually accelerated, hitting 3.1% in July, a 5-month high. This shows that price pressures are broad and embedded in the economy. It's why the cost of shelter and medical care keeps climbing, quietly eating away at your purchasing power. So you have a weak job market and persistent inflation. On top of that, overall economic growth is slowing. The Federal Reserve has cut its GDP growth forecasts for 2025 down to just 1.4%. Slow growth, sticky inflation, and a fragile job market. The complete ingredients for stagflation are no longer a distant threat. They are here. If stagnant jobs and rising prices sound familiar, it's because America has been here before. The 1970s were defined by an economic malaise that some called a lost decade, and there are unsettling parallels to today. Back then, the crisis was kicked off by a massive supply shock, the OPEC oil embargo, which sent energy prices soaring. That shock drove up the cost of everything, fueling inflation while crippling the economy. Today, we are dealing with a different kind of supply shock. These once self-inflicted tariffs. According to a report from Yale, new tariff policies have pushed the average effective tariff rate to 18.6%, its highest level since 1933. These tariffs are essentially a tax on imported goods, and those costs are being passed down to consumers. One analysis estimates these policies could cost the average American household around $2.4K a year. It's a direct hit on your wallet and a key driver of our current inflation. This dynamic puts the Federal Reserve in the policy trap of stagflation. Usually, if unemployment is rising, the Fed cuts interest rates to stimulate hiring, but it can't do that now without risking even higher inflation. On the other hand, if it raises rates to fight inflation, it could crush an already weak job market and possibly tip the economy into a recession. This difficult balancing act is happening in real time. The Fed has held interest rates steady for 5 straight meetings. Inside the central bank, there are clear disagreements, with some wanting to cut rates to support jobs and others worried it will make inflation permanent. That uncertainty creates risk for everyone. And experts are taking notice. Bank of America has warned that the current policies are a recipe for mild stagflation. The OECD has pointed to a stagflation-light scenario driven by this combination of slowing growth and rising prices. While most forecasters don't see a deep recession, the consensus is that we are entering a challenging period. Navigating the economic environment will be a major financial challenge. If you want to stay ahead and get clear strategies to protect your wealth, make sure you subscribe to my channel and hit that notification bell. I break down what the headlines mean for your money every single week. So, in the face of this stagflation-light scenario, what can you actually do? This isn't about panic. It's about preparation and focusing on what you can control. Here is a playbook for building financial resilience. First, reinforce your personal finances. In this environment, the fundamentals matter more than ever. That starts with a zero-based budget where you account for every dollar. When prices are rising and income feels less certain, a budget is your first line of defense. It gives you control in a situation that can feel out of control. Number 2, an emergency fund is non-negotiable. With a cooling job market, having 3 to 6 months of living expenses saved up is a necessity. It's the buffer that can keep you from taking on high interest debt if you were to lose your job. Speaking of which, it's time to aggressively pay down high interest debt, especially on credit cards. With core inflation running over 3%, any debt with a higher interest rate is actively making you poorer. Paying it down provides a guaranteed tax-free return on your money. Once the financial foundation is solid, you can turn your attention to investing. Stagflation shifts the rules of the game. The mindset needs to shift from growth at all costs to resilience and cash flow. Historically, long-term bonds and speculative stocks without current profits tend to perform poorly during stagflation. Bonds get eroded by inflation, and the future promise of unprofitable companies is worth less when money is tight. So, where do investors often turn? They look to real assets. Commodities, including gold, have historically acted as a hedge against inflation. But often, the real winners are specific kinds of companies. I would look for businesses with strong balance sheets and, crucially, pricing power. The ability to pass rising costs to customers without losing them. Think of sectors like consumer staples, healthcare, and energy. This isn't financial advice, but a look at the historical playbook for this kind of scenario. And finally, protect your most important assets, your income. In a weaker job market, the best defense is a good offense. This is the time to focus on becoming indispensable at work. Invest in yourself, learn new skills, take on important projects, and show your value every day. The more valuable you are, the more secure your position is. The threat of stagflation is no longer a distant chapter in a textbook. It's probably our current economic landscape. The data on slowing jobs and stubborn inflation are clear, but understanding the situation is the first step to navigating it. By focusing on what you can control, your budget, your savings, your debt, your investment, and your skills, you can build a financial fortress that is ready for the turbulence ahead. The 1970s was a lost decade for many who were unprepared. This time, you can be ready. And I have already published videos for all that I talked about earlier. So, what steps are you taking to prepare? Let me know in the comments below, and be sure to watch my next video on the analysis of the Fed's September decision. See you all in the next one. Bye bye.